have done some of the basics or the introduction of the derivatives. Under that, we have also understood the option chain. Yes or no? Have we understood the option chain? Am I
I
audible?
believe not, sir.
No? Okay. Okay, I'll introduce you option chain. But all of you are aware about, we have discussed about future, forward, option, swap, then forward rate agreement. This thing you already have studied in derivatives, and on the previous class also we have introduced how these forward, future, option swaps are happening. Whether
Yes,
any
sir.
forward transactions are happening now? Any forward transactions are happening now? Whether forward transactions are there now or not?
Sir, I assume they are there.
Yeah, how they are there? How we can assume?
Sir, I don't think there's any reason to believe that they've stopped forward transactions.
Yeah. So one is they are not. We say they are not recognized, like they are not traded in the recognized exchanges or in the secondary market. Two is Neil, am I audible?
Audible, sir, but you lost your voice in the middle.
Yes, yes.
You
So
basically
I'll
froze.
I'll do one thing. Yeah, I am in a different place. So I'll just do one thing. I'll stop my video. Then audio will be good, I think. Yeah.
All right, sir.
Yes. So okay. So whether forward is there or not there, that is a big question. Now Neil also said it is there, but how it is there? Can anyone say? I hope I have given some example how forward transactions are happening now. Whether forwards are there or not there.
Sir, at the end of the day, forward transactions are just a contract between two people to go ahead with a certain buy or sale of asset on a given date at a given price per matlab, set price. So I don't think there's anything that anyone can do to stop from these contracts from occurring. So as you mentioned, they are not available on secondary markets, but that does not stop the fact that they will always be happening in like people will always be entering into these contracts.
Yes. So that is good thing. Like forward is there, whether you record it or not record, or whether you note it or not. Forward is there even between the farmers or between the businessmen or between you and me or one to one friend also. Forward is there. But if you see to record the forwards, or if you see somehow forwards are being managed, that is done through financial institutions or banks, they participate more in these forward transactions. Even they participate more in the swap transactions. Those two are OTC contracts, forward and swap. Swap also is a OTC contract or over the counter traded. These are all OTC contracts, and many banks participate in this forward and swap. If you see forward transactions, how much transactions banks are doing, you will also able to get it from say CCIL website or FIMDA website for India. And if you want to see forward transactions all over world, you can go to BIS, Bank for International Settlement. You will get region wise forward transactions in each of the underlines. Either you go for currency, commodity, or interest rate or equity. Okay. So forward transactions are more happening between the banks or financial institutions. And who can say what is swap? Have we discussed about what is swap, how it is happening?
In financial derivatives, we have discussed. So basically, you exchange without changing hands of assets or liabilities. You get the benefits or the costs accrued to the other party's asset or liabilities.
Yes. Anyone can say what is swap?
So swaps basically gives to party the ability to exchange cash flows without transferring their assets and liabilities. So basically, it is cash flows are being transferred between the two parties.
Okay. Good, Rahul. Anyone? Mihir, Saranya, Rishabh, how this swap is happening?
Sir, it's an agreement between two parties. Sir, can I give an example of loan?
Yes, please.
Sir, I have seen about loan example, like one party has advantage in fixed rate, other party has advantage in floating rate. So they each borrow money on basis of their strength. Then they swap cash flows for each other and pay the interest on the loan, and then whatever saving is made, they divide it amongst themselves in a predetermined ratio.
Yes. So Mihir is correctly specified. One is fixed rate, another is floating rate. Okay. Where this fixed rate and floating rate will come, either it will come in interest rate, fixed interest rate, or it will come in the fixed exchange rate. Okay. Again, floating interest rate is also there, and floating exchange rates are also there. Okay. So can we say, yes, fixed, we understand that if it is the saving bank deposit is 3%, that is fixed, or you say demand deposit is 6%, that is fixed. Now, how does floating works? How floating interest rate works? So
So
it is,
fiber or LIBOR plus something.
yes. So benchmark plus, so you can say some percentage, suppose say 2% plus benchmark, or 3% plus benchmark rate. So this floating rate is, we say 2% plus benchmark rate. This benchmark, which will be benchmark. Now you can connect with LIBOR or MIBOR, which LIBOR is internationally a benchmark, or MIBOR you can consider Mumbai Interbank Offer Rate as a benchmark rate. Suppose say this benchmark interest rate is 3%. Now your floating rate becomes 5%. If benchmark rate will increase to 3.25, your floating rate will increase to 5.25. If benchmark rate is increasing to 4 or 4.25, then your floating rate is increasing to 6.25. So if it will come down to suppose say 1.5, then your floating rate will come down to 3.5%. That means your interest rate of the instrument that you hold, if it is floating, it will change when benchmark will change. If benchmark is going up, your interest rate will go up. If benchmark is coming down, your interest rate will come down. Okay. Now what happens? Suppose Rahul is there and Mihir is there. Rahul is having fixed interest rate instrument and Mihir is having floating interest rate instrument. So when Mihir will get benefited when this benchmark rate will get increase, Mihir will get higher, say higher interest rate or higher coupon. But if Mihir will expect this benchmark rate will come down, then Mihir will think that fixed rate is good. Yes or no, Mihir? If you will think that market has started falling down, this new variant of COVID has come now. If you think that interest benchmark rate will come down, then your interest rate will also come down because it is linked with your benchmark rate. Now you will think that if I prefer fixed rate, I will get 6%. If I prefer this floating rate, I will get 3.5%. So it is better to take fixed rate. Yes or no?
So 3.5 is the floating rate, right?
Yeah, floating rate. Yes.
I'll prefer lower interest rate. No, so 3.5 I'll take. No.
You have invested. Now you are not taking loan. Don't
Acha,
think
sorry,
that.
investment. Okay,
Yeah,
investment.
you have
I was thinking
invested.
of
Now you are getting return as interest rate.
Okay, so 6% then.
Yes. So you will prefer like if prices, this benchmark rate will come down, then your total return will also come down. That's why you will not prefer now the floating rate. You will prefer the fixed rate. Now Rahul thought that this is lower to him and he will prefer to have floating rate because he is expecting the benchmark rate will increase. Mihir is expecting benchmark rate will decrease. When Rahul is expecting benchmark rate will increase, Rahul will prefer floating rate. Now Mihir is preferring fixed rate. Then they swap with each other. Okay. Mihir will give his floating rate to Rahul and Rahul will give his fixed rate to Mihir. What is constant over here? The underlying is constant over here. All of you understood? All of you understood?
Yes, sir.
Yes. So this is called swap. Either it can be interest rate swap or currency swap. If you open any derivative books, they will start with either interest rate swap or currency swap. These two swaps are more popular and highest transaction is happening between financial institution with these two swaps. Okay. Any question on swap?
Uh, Not really, sir.
Okay. And future, all of you have understood on future. We have near month, far month, and mid month. Okay. So near month, far month, and mid month, three contracts always you will find on future. And you can see the last month's last Thursday is the expiry day for you. See
So we are losing your voice if you can hear me.
Yeah, I think that's good.
Now it's coming. If you could just repeat the last 30 seconds. I think you're talking about near month, far month, and mid month, and
Yeah.
that is the number of months from expiry.
Yes. Yes. Yeah, that is what I'm showing you. If you see there are three contracts available on Nifty, you can simply use this link. I think those who are trading with derivatives, you are aware. Those who are not, you can just see. We have three live contracts that are available now. One expiry is 30th December. Another is 27th Jan, and that is 24th February. So 30th December, how it came? Okay. Okay. So there are three contracts.
So 30th December is the last Thursday of December, no? So that's why.
Tomorrow.
So we've again lost your voice. So
So month. Reason. Okay, am I audible now?
Yes, sir.
Okay. So, so what we are getting over here is one is near month, that is 30th December contract, then mid month and per month. And the last prices are there, that trading is happening, and changes like today market is off, yesterday it was down like anything, then percentage of change, volumes, then value of trade, and open interest and underlying value. So underlying value is the spot price. Now if you see this trading traded value and open interest, both are high in the near month, because many are participating to because this expiry is nearby, so that they can book a good amount of profit. Then open interest is also high. And if you see the per month will always have lower volume and value and open interest, and the mid month will have second highest. Now, what is that open interest? I can remember that I have told you what is open interest. In the last class, we have taken some example on open interest. Yes or no? Can anyone say what is open interest?
so the number of contracts which have not been closed out.
Number of contracts which are open or not closed down. Okay.
Yeah, not squared up. I think squared off, I think, is the
Yes.
term.
Yes. Not closed down, or in terms of market, we call it as not squared off. Okay. It is not squared off. Now, what does that mean? If I have bought 200 contracts, I have to close that 200 contracts by selling it. If I have only bought and wait till expiry or till some days, then it becomes one open interest. So this 200 becomes open interest. Now, if I have bought 200, suppose say Neil has bought 100, suppose say Rahul has bought 50, Mihir has bought 100, then open interest becomes 450. Okay. And if Neil will close down 50 minus 50, Rahul will say close down 20, or all 50, then what will be open interest? Now change in open interest will be 100 minus 100. Now open interest will become 350. Okay, open interest will become 350 because this has been closed down. Okay, whenever they have first time taken, they have taken from the market from others, so their position are on. These positions has not been closed down. But whenever they themselves has closed down or sold, they have bought it, and when they sold it, then the open interest will come down. Okay, and if they will keep on adding, suppose say I will buy 100 more, then open interest will be keeping on increasing. Okay. So addition and deletion or reduction of open interest also happens. Okay, so okay, so open interest changes like that. Now, we'll go for option chain. So we'll understand the option chain. Yes. So okay. Now in front of us option chain is available. Now all of you are again aware what is option or what is option chain. Let me open that. Okay. Okay, forward future differences, you know. So uh, okay, let us discuss about futures payoff. If you want to buy one future, you are bullish on Nifty. If you buy it, how does your payoff looks like? I hope all of you have done the payoffs during your derivatives. Yes or no?
Yes, sir.
Okay. So just tell me if you have bought at 8,600 and Nifty at expiry ranges from 8,200 to 9,000, where how does your payoff will look like? Or how does your payoff will be? 8,600, 8,200, say 300, 400, 8,500, like that. So you will earn something or you will lose something if Nifty ranges from 8,200 to 9,000 in the expiry. So when you will get benefit if it is above your buy price or if it is below your buy price. The strike price is the
Above.
Above.
above your buy price. Okay. So just same, if you have bought at 8,600 and at expiry it is 8,200, then your you will lose 400 rupees. And if it is 8,600, then 0. Then if it is above your buy price, then only you will get benefit. It is just like your stock, or just like say trading in spot market. Okay, so you will get benefit from if prices will move up from your buy price. Okay. Now
Sir, I have
so
a question.
yes.
So we just pay premium, no? We do not look at strike price while calculating these payoffs.
So
So if it,
this is future. This is
that's
future.
okay, this is future.
Yeah,
Okay.
we'll go to option, that premium part. We'll go to that. Yeah. So future is not having premium. Okay. So we'll get unlimited profit and unlimited loss whenever either side moments will be there. And this is called as a linear payoff, because if you see, it is straight line or linear payoff. Now, whenever your bearish market is started falling, then what you will do? You will do the the same if expect or benefit. So you have done a short selling. Okay. So at 8,600. Okay. And your my voice is not audible.
Sir, it's audible now, but when you were explaining, we lost your voice.
Oh, okay. Sorry for today. Just uh, my I came to some other place. That's why it is not. I'll just try this. Now am I audible?
Yes, sir.
Okay. Okay. So if we are doing short, okay, then whether we will be in profit or loss. If we are doing short at 8,600, if the spot price will increase, then we will be in profit, or it will decrease, then we will be in profit.
So could you repeat all the numbers? You are taking the strike price at?
Okay. So I have taken a strike price of 8,600. Okay. And the expiry, if his spot price will be ranges from 8,200 to 9,000, and I have taken a short position at 8,600. So I will be in profit if prices will go up or will come down.
Sir, between 8,200 to 8,600, you will be in profit. Above 8,600, you will be in loss.
Yes, because whenever you are doing short, you are selling at high, and you if you buy at low, then only you will be in profit. If you are buying at high, then you will be in loss. Okay, so the short future is also just opposite of long future. So if it is lower than your sell price, then you will be in profit, and if it is higher, then you will be in loss. Okay. then it is also linear, then unlimited profit and unlimited loss. This margin, we will come to that margin. Now, there are ways of maintaining margin. The new margin system also will discuss. But now just think about option market. In the option, we have like option gives rights, or option contract gives the buyers the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. So in this definition, we have four types of options. If it is buy, then it is call option, right to buy, then right to sell, put option. On the expiry, then it is European or American option.
If it is
On
if it's on, then it is European, and if it is on
European.
or before, then it's American.
So European option, then it is on or before, then it is American option. Okay. So there are four options that are available in this definition. In Indian market, we don't have American option, we have European option. We have introduced for a small period of time this American option. It was very difficult to regulate. Then we have only European options, and we have both call and put. Okay. Now, in the option, we need to understand several terminologies. One is index option, then stock option. The underlying is index, then it is index option. Underlying is stock, then it is stock option. Buyer of the option who like buy paying the option premium. So we are not giving the exact amount of underlying. We are only paying the option premium, or that option premium is called as option price. Okay. So that option price, how we decide this option price, or how we decide the option premium? Am I audible?
Yes,
Are
sir.
you? Yeah. So how we decide option premium?
So the market decides, like, based on the demand and supply.
And demand and supply, it will get changed. Okay, it will go up or come down.
Oh, are you asking the fair value?
Yes.
So through models.
Yes, through
Binomial
option pricing
modeling.
model. Yes, through option pricing models. We'll do that option pricing model through R also. So through option pricing model, this premium gets calculated. So then Black-Scholes option pricing model was developed somewhere in 1972 or 73. Thereafter, only options has been started trading, because before that it was difficult to like price the option, how we can decide this premium. But after that, it was easy. That's how they got Nobel Prize for the developing Blacks and Scholes got Nobel Prize for developing this option pricing model. Okay. And all of you understood, like buyer has a right, not obligation. Can anyone say what do you mean by right and not the obligation?
So if the market is not favorable to the owner of the option, then he can forfeit the the purchase if it is not in favor of if it is not in the favor, he will just forfeit and like lose his premium rather than executing and squaring off the option that he has bought.
Yes. So what will happen if suppose I come into a contract to suppose I have bought at 100. Okay, I have came into that contract, and at the expiry I am in the loss. So suppose at expiry the spot becomes 80 rupees. So I have paid 5 rupees say premium. Okay, if I'll exercise this, I'll lose 25 rupees. If I'll not exercise this, I'll lose the premium, only maximum the premium, that is 5 rupees. Okay. So I have a right but not the obligation. I am not bound to exercise that. Okay, if I will not exercising, I will only lose the premium that I have paid. Okay, in many books you will find like the shopping malls. Whenever you are going, uh, you are getting some offer on that day, and you don't have money on that day. But the next day that offer will not be available. Next day that offer will not be available. So you can come into a contract with the shopping mall manager that you will buy that shirt at say 100 rupees. One 5,000 shirt is sold at 100 rupees. So or say 500 rupees, and you will pay some 10 rupees per contract or 10 rupees per shirt. You are paying to the shopping mall manager, and you have taken 5 days time. Within 5 days, if you are not exercising that, then you will lose this 10 rupees only, not more than 10 rupees. Okay, so that is why the buyer has a right but not the obligation, but the seller will not able to sell to anyone else other than you, because seller has received the premium. So who has received the premium, he is obligated. Who has paid the premium has the right. Okay. You understood this right and obligation?
Yes, sir.
Okay. And the option writer is option seller is otherwise known as option writer. Then call option and put option we same. Now this option premium that is decided uh, through option pricing models. Then expiry date. What is this expiry date? On that day, the contract will expire or contract will die. And after that day, will you able to get that contract? You will not able to get that contract. The new contract will be built up based on that underlying, but the same contract will not be available. That is why we call it as expiry date. Normally, the expiry date for option is, for index option it is every, when the expiry date,
So is it every Tuesday? Or every
not
month, last Tuesday,
not Tuesday. It is Neil.
Thursday?
Maybe
Yes,
Thursday, last Thursday of
yes,
every
it
month.
is Thursday. So
Sir,
no,
I didn't know that actually. I think someone mentioned in class right now.
no, for index option it is every Thursday. Every week's Thursday is the expiry for index option. But for stock option, it is last Thursday. And again, stock futures also last Thursday. Okay, last Thursday. Now, suppose you are able to see some of the contracts that is expiring on 30th December. If you want to trade on that particular contract after 30th December, it will not be available. It will die or it will be removed. It will get settled down. Okay. Now, strike price or it is also known as exercise price. Then American option and European option we have discussed. Now, can anyone say what is cash delivery? We say on expiry, either it will be cash delivered or it will be physically delivered.
Sir, cash delivery is setting off of contracts. Like basically, if you have put option and it is exercised, then only differences will be credited to our account. When physical delivery, we actually take the delivery of the share at the specified
Yes,
price.
yes. So in cash delivery, the settlement will be on cash, and on physical, you have to get the underline. Okay, you will get the underline. Now, if I am getting the underline, Suppose say I have bought SBI future. I'm getting, I have bought say 200 SBI future. Someone has sold me 200 SBI future. Okay. Now, from whom I'll get this 200 spot? Are you getting my question? I have, I am saying this is physically settled. In case of case settled, this problem will not happen. When physical settlement is there, I have considered buying 200 SBI future. That means on the expiry, I'll get 200 SBI share. Yes or no? Are you
Yes, sir.
getting the question? So, from where I'll get this 200 SBI future?
From the seller.
From the seller. From seller, where seller will get this 200 future?
So from
Uh,
exchange.
From exchange. Exchange is
Sir,
having some
it's
storehouse or some.
the shares are just trading. The shares are just changing hands from the traders only.
Yes,
So
but see, all of you are aware about three categories of participants in derivative market. One is speculator, then second one is hedger and arbitrator. Okay, this arbitrator and speculator will not be there till expiry. On the expiry, hedger is there. So hedger is hedging because hedger wants to get benefit from the spot market. That's why hedger has come into a derivative contract. Now you are also selling. You are a seller. Okay. One buyer is also there. Suppose Rahul is selling, Mihir is buying. Okay. Now Rahul is not having this 200 contract, 200 on a spot. Okay, just think about the practical aspect. Here, the problem how it will arise. Rahul has to give, since Rahul has sold, Rahul has to give 200 SBI share to Mihir. From where Rahul will get? Rahul is not having 200 shares, but he has sold 200 contracts.
then
Sir,
I
I
think
guess.
he might have to buy first and then sell.
Yes, no, he has already sold, but on the expiry, exchange will help to buy, but means through exchange only he will buy, but he has to buy from the market and settle down or give to Mihir because he has came into sell contract of that particular underline. Okay. In our market, whether cash delivery is there or physical delivery is there.
Sir, I
Neil,
believe both are there.
both are there. How?
Sir, it depends what is the market and what is more prevalent in the market. I think cash deliveries are more prevalent.
It was okay. We are having only cash delivery. It was cash settled. Now we have for stock derivatives, compulsory physical delivery is there. Okay, you don't have physical delivery. You don't have option for cash delivery. You have to do it in physical delivery. But for index contracts or index derivatives, we have cash delivery. We don't have physical delivery. Okay, or cash settled. Now, in a
So could you
suppose
repeat? So could you repeat where all cash is allowed, where all cash is strictly not allowed?
yes, yes.
Could you repeat where all cash is allowed and where all cash is strictly not allowed?
No, yeah, I am repeating. So I'm saying for stock derivatives, we have compulsory physical delivery. physical delivery. Okay. If you are there till expiry, if you are a buyer, you will get the shares. If one seller is there, seller has to give the shares to buyer. That is compulsory physical delivery. If you are a speculator, you don't want this physical delivery, then you will come out from the market before expiry. Before expiry, you can sell your holdings or your contract and settle down and come back, or square off your positions and come back. But if you are there till expiry, you will get physical delivery. You have to get the physical delivery. But for index option, can we give index as a underlying to any of the parties or any of the traders? We can't give. So for index, it is cash delivery. For stock, it is physical delivery. For index, it is cash delivery. Understood?
So only cash or
Only cash. So for
compulsory
index,
cash?
only cash. We don't have,
Okay, sir.
sorry? Yeah, we
Okay,
don't
sir.
have physical delivery. The complexity will increase if we will mandate index options and futures physical delivery. The complexity will increase because you have to give those 50 stocks shares with weightages, and
Yes,
it will be a
you'll have to
difficult task.
create the basket. Yes, sir.
Yes, it will be difficult task. So we settle down this on case and stock derivatives on compulsory delivery. Okay. In case of commodity, I hope all of you are aware about commodity. Commodity derivatives you are aware about?
Sir, not too much.
Okay, next class, just remind me. I'll explain you how commodity derivative is working in Indian market. Okay. So in commodity, we have physical delivery as well as cash delivery. Their option is there. Before 5 days of expiry, you have to opt whether you want physical delivery or cash delivery. But if you are a hedger, you are trader, suppose you are a gold trader, you want physical delivery of gold, you have to go to the warehouse wherever gold warehouses are there, like normally in Ahmedabad and Mumbai, gold warehouses are there. You have to go there. If you are from say Delhi, you have to come down to Mumbai to get those physical delivery of those commodity. So in commodity, again the complexity increases, but I am audible now. Am I audible?
Yes, sir. Now you're again audible. Yes, sir. Now you're audible again.
Yeah. So in commodity, there is something called staggered delivery system, where before 5 days you have to decide whether you have to inform to the exchange whether you want physical delivery or cash delivery. So accordingly, it will be settled down. If you see many of the spices, those are available from the South India, like Kerala is more famous for the spices. The warehouses for those spices are in Kerala. So if you want to get delivery of black pepper or cardamom, you have to go to Kerala and get that. So those are trader, they are going and getting the physical delivery, but or else it is cash settled. Yeah. Okay. Then you all are aware about in the money, at the money, and out of the money. Yes or no?
So we discussed very briefly, but if you can explain again, it will be good.
In the money, at the money, and out of the money. Okay, you can do one table on this. So you can say this is for call and this is for put. Call in, so at the money means spot equals to future. So always we use this k to represent future in derivatives. So k is for future, s is for spot. Put also s equals to k or spot equals to future. Now in the call, in the money is when spot is less than or greater than future. When
Greater.
spot is greater than future. Okay, then it is in the money call. And in the money put, when spot is less than future, that means future is greater than spot. Okay, you can write down spot is greater than future. Future, and this here spot is less than future. Now out of the money, the opposite of in the money is out of the money. When spot is less than future, then it is out of the money call option. When spot is greater than the future, then it is out of the money put option. All of you understood these 6 categories, 3 on call, 3 on put. Are you getting? Let us see
Yes,
in the
sir.
option chain. Let us see in the option chain. Now you say this is strike price. This is the option chain. You can I'll just share the link. You can see this option chain. Okay. So you can see this 15,900 in the call side. One is call, another is put. Now think about call side only. This 15,800 will be in the money or at the money or out of the money. In the money, at the money, or out of the money. 15,850. Now what is spot? Spot current market. What is the current market? Current market rate 17,000 plus. What is that? Let us see. The underlying value 17,053. Okay. So okay, this came down to 16,958 now. Okay, 16,958. We have seen a little bit correction today at the end of the session. So it is 16,958. Now 16,958 is the spot price. Then if I am considering 15,700 as a strike price, so K equals to 15,500. Then it is ITM, ATM or OTM. Now spot is higher than future or lower than future.
Sir, call is in the money.
It is call
Call is in the money.
in the money, ITM. Okay, call in the money. So because spot is higher than the future. Okay. If I'll say put side, if it is put, then it will be for put. If spot is 16,589, 16,958, and K is 15,500, then in the put it will be this page. Out of the money, yes or no? Just see. This will be out of the money or not?
Yes,
OTM.
sir.
This is put OTM. For call ITM or in the money, but put out of the money. Now think again. If we will go down, so 16,250 will be in the money or out of the money? Call option.
Sir, in the money.
In the money. 16,850
In the money.
in the money. Now if we'll come down 17,100, if 17,100 is future or K, 16,958 equals to S, then this is in the money or out of the money? Call option.
Sir, OTM.
OTM, call or put?
Sir, call.
OTM, call. All of you understood? This is your revision. You have already done in derivatives also.
Sir, I have a question.
Yes, please.
Sir, this necessarily means that am I still making the money or I'm losing the money? That's how we have to interpret it, right?
Yeah, that yes, in that sense also you can interpret. But if you are losing or making money, that depends on the option price or premium. Okay, this price or premium that will come to the payoff, but you can interpret on that way also, whether it is out of the money or in the money. But that is in the call side. Okay, that is in the call side. Are you getting Mihir? Who was asking Mihir, right?
No, sir. Sir, could you please explain?
Yeah.
Like in the call side, when you say in the call side, what does it mean?
In the call side means this is right to buy.
Right.
Call means right to buy. If that contract is right to buy, then suppose I have bought at 17,100. Okay, 17,100 I have bought. If I'll exercise at 16,958 in your way, I'll be in loss. That means I am out of the money.
Right.
Okay.
So
So
it's on
if we,
execution. Is it on execution only when we say that if
yes,
we are in the money, OTM or ATM?
yes. So you
On,
will always compare with execution.
okay, sir. Got
Okay.
it.
Okay. So, but this case, OTM for call is in the money for put, ITM for put. Okay. If it is OTM for call, then out of the money for call, then it is in the money for put. If it is in the money for call, then it is out of the money for put. You are getting these two things?
Yes, sir.
Okay. You can note it down so that you will not forget. Again, we'll also see here in the NSU website, you can see up to the 17,050. Now it is 16,969. So yes, we have left out one concept, that is ATM. So ATM is this 16,958 is spot. We are saying if we exercise is also or future price is also 16,958, then it is at the money. But in reality, at the money contract you will never find, because it is the underlying is changing based on market activities or buy and sell in the market. So at the money is in between this line. This line you can see above this in the call side, the shaded area is there or the solid area is there. That shaded area is in the money call. And if you come down the white area, this 17,350 will be in the money or at the money. 17,350. 17,350 will be call out of the money. Yes or no? Am I audible?
Yes, ऐसे strike क्या है?
Strike 17,350.
Okay. Yes, sir.
Okay.
OT.
We are out of the money call option. Okay. I think it is going. We are out of the money call option. Now you say these two color you can see, white color and another is gray color or the solid color you can say. This shaded area or solid color is in the money call option. In the money call option. If you come down in the call side, white area is out of the money call option. Okay. By looking into color, then you can see the strike. Yes, it is out of the money. So in the looking into color also, you can simply say this is in the money if it is shaded area, this is out of the money if it is white area. In the put side, white area is the above, so this is out of the money, below is the in the money option. Clear? Yes or no? Now for any of the option chain, you can you able to identify in the money, at the money, out of the money? For any of the option chain, can you able to identify in the money, at the money, and out of the money?
Yes, sir.
Okay. So whatever the underlying is, either currency or commodity or interest rate or equity, the same thing follows or same process follows. Now you understand what are the items that are there in the option chain. One is OI. What is that OI? That is the open interest. What is that? That means these are the positions that are on in the market. They have not been closed out. Okay. Now change in open interest. What does it mean? Change in open interest. Change in open interest. Who can say change in open
So
interest?
change in open interest might be either the new opens new contracts opened or the contracts which have been closed.
Yes. So in our
Like the
example
net
also
of them.
we have taken. Yes, we have taken some example. I think we have erased that. So if we knew, if we open interest is 5,000 and some more open interest are getting added, 5,000 plus 200, that means this will become 5,200. So open interest, change in open interest becomes plus 200. Suppose from this 5,200, some of the traders has closed their position. Suppose say 1,000 has been closed, minus 1,000 has happened. That means open interest becomes 4,200 and change in open interest or change in OI becomes minus 1,000. Okay. Now change in open interest means if it is positive or negative, that means more people are closing the position. If it is negative, if it is positive, more people are getting the position or more people are entering to that contract. If it is positive, then people are more say confident on getting those contracts because they will get benefit. If it is less, that means people are started booking their profits and they are started closing their positions. But initially you can see change in open interest is hyphen, that means nothing is happening. if you look into near about the expiry, near about the spot rate, that means near about the at the money, you will get change in open interest as well as open interest. Change in open interest today is not showing anything, any problem. Okay, so change in open interest, you will get something. Why nothing is showing? We can change this. See, the expiry date are each of the Thursdays of the each of the weeks Thursday. Okay, 2nd December one expiry is there, or option. Okay. Now, volumes. Then, what is difference between volume and open interest? If I will say this 5,000 was open interest, 200 got added, 5,200 becomes open interest, 5,200 also becomes volume. Okay, sorry, 200 becomes volume because 5,000 was there previously. Volume is 200. Now 1,000 again got added, reduced. Now the volume 1,000 will be added over here. Now volume becomes 1,200. Okay. So open interest will calculate, add and subtract. Volume will add everything, whether it is addition or subtraction, creates one volume. Okay. And both buy and sell creates one open interest as well as one volume. Okay. So volume means this many addition has or deletion. Either addition or deletion has happened. Now IV, what is IV? IV is the, what is IV?
Implied volatility.
What is that?
I think it's the uh, sensitivity of the option to the price changes. I
Yes,
think.
sensitivity of the option to the price changes, or it is called as future volatility. Okay, so we calculate how much volatility, sorry, how much volatility will be there in the in this particular contract. That is called implied volatility. That again calculated implied volatility is one of the parameter in the Black-Scholes model. So that is again calculated through using Black-Scholes model. If implied volatility is 20 to 30, that is good. If it is 30 to above, that means it is too volatile or too risky. Okay. And LTP, what is this LTP? This is LTP means
Last traded price.
last traded price. That is the option price, that at that price trade is happening. And change in LTP, whether it has gone up or came down. In many cases you can say it has gone up, in many cases came down, in so many cases came down. And if you come to near about to in at the money, you'll get the option price is, option premium or last traded price is very low, 90 rupees, 68 rupees, 36 rupees, 5 rupees, 2 rupees, 1 rupee. But if you go far, you are getting 1,500, 1,400. These are option price. Then bid quantity, bid price, ask quantity, ask price. These are the call side buy quantity, buy price, sell quantity, sell price and sell quantity. These are the order book or the highest layer of the order book that is available. Then strike prices are there. Okay. All of you understood all the items that are there here in the option chain. If you understood call side, put side also same items are there. You want me to repeat any of the item, you can ask me. Am I audible?
Yes, sir, you're audible.
Yes, sir.
Okay. Now we'll see another magic from this option chain. We get some new information that is called support and resistance. Have you heard about support and resistance? Support and resistance.
Sir, I think these, when you're doing technical chart analysis, it comes into picture out there.
Yes, in technical analysis also it comes from option chain also you will get the support and resistance labels. Okay. Now your task is to identify the highest open interest in the call side. In the call side, what is the highest open interest? Can anyone say? Highest open interest?
The 121933.
121933. 123 also is there.
Oh, sorry, yes. 123585.
So take these two. 123,585. One is 123,585. You say this is max 1, OI max 1. Okay, maximum 1, OI that side, call side. Okay. Second one is 121,933. 121,933. This is OI marks 2. You can say this is second highest, this is first highest. Yes or no? Yes or no?
Yes, sir.
So what is the strike over here? What is the strike over here? Just see 1, 2, 3, 585. Strike is 17,500. That is 585, 17,500. And this one 121, 17,300. 17,300. Okay. So keep these two in your mind. Two highest open interest we have seen, and those two highest open interest are in the out of the money call. You can see in the money call highest are not there. So highest open interest we have reported. That what does it mean? That means more people are liquidity of here, or more people have taken open positions at this strike. Yes or no? Yes or no?
Yes, sir.
Now come to put side. Put side, what is the highest open interest? Can anyone say 36,000, 34,000, 45, 60,000, 32,000, 61,000? So 61, 85,000, 85. Okay, 85,000 is the highest, right? So 85,000 is the highest in the put side. Put OI max 1 equals to how much? 85,159. The strike is 16,000. Okay, strike is 16,000. Now second highest, which is second highest? 61. Anything higher than 61? Anything is there higher than 61?
No, sir.
No. So 61,737 and the strike is 16,500. 61,000. Sorry. 1,737. So 16,500 is the strike. Now we call it as OI max 2 in the put side. Okay. So we get one is highest in the 17,500, lowest is 16,500. Again, second one 17,300 is highest, and 16,000 is highest in the this one. Yes, 16,000 is the max one. What does it mean? This means whenever you travel, you have configured a Google Map. In the Google Map, have you seen some red lines? Sometimes we see very solid red lines. Yes or no?
Yes, sir. That shows more traffic.
More traffic. But does that mean we can't cross that red line? It
No,
doesn't.
sir.
It indicates it will take some time to cover that red line or to that traffic. That means more people are there in that red line, or more traffic is there. So this traffic here is 17,500. So the current, what is the spot price? Spot is 17,053. If I'll say 17,053 is the spot. Okay. If I'll do one Google Map from 17,053 to 17,500, or I'll say I'll do one Google Map from 17,053 to 18,000. In between this 17,500 will come. Yes or no? So this doesn't mean that I can't cross this 17,500. This means that it will halt for some time over here. But if it is breaking, then it will move upward or it will go up. But chances are there it may come down or it will be here. So this 17,500 is support or resistance? This is 17,500.
Resistance.
This is resistance. Okay. Now if it will break, okay, first resistance we will get at 17,300. 17,300. Let us change the color. Suppose 17,300 first resistance, second resistance 17,500. Okay. On the support level, okay, on the support level, the first support will come at 16,500, second support will come at 16,000. So without pivot or without technical, you can also identify support and resistance. Yes or no? Support 1, support 2, resistance 1, resistance 2, by looking into open interest in the option chain. Clear? Stuti, Ayushi, Gaurav, am I audible to all of you?
Yes, sir, clear.
Yes, sir.
Okay. You want me to repeat? Do you want me to repeat?
No, sir.
Okay. So support and resistance you have understood from the option chain. Now how does it will help us to take the strategy based on support and resistance? How does it will help? If I come to know this is support, this is resistance, then how I will take the strategy?
So one can be like to go with the flow, or meaning like 17,500, if it is the resistance, then we can also sell calls at that point,
Okay.
or buy yeah, sell calls at 17,500, or sell puts at 16,300.
Huh. So this gives an indication in the road if I'll go, what is the maximum I'll go, and what is the minimum I can go. Okay. Again, there are so many strategies built up with considering this support and resistance. We'll see the strategy. Uh, okay. Now, in the money, at the money, out of the money, we have understood. Now, you see, there are two value in the option. Option price or option premium carries two values. One is intrinsic value. Okay. Another is time value. Okay. Intrinsic value and time value. What does that mean? Intrinsic value and time value. What does this mean? All of you have done the intrinsic value and time value in the derivative.
Sir, intrinsic is the fair value, which is uh, the fair value of the underlining, and time value, I think, time value, I'm not aware, sir.
Time value is unfair value.
No, sir. Sir, basically, maybe with time, how the value is appreciating or depreciating for the asset.
Yes, see, the premium itself is divided into two categories, or the option premium carries two value. One is intrinsic value plus time value. Okay, intrinsic value plus time value, that is called as premium. How we'll get this intrinsic value? The intrinsic value of call is the amount of the option is in the money. If it is in the money, then we have intrinsic value. If it is out of the money, then intrinsic value is zero. Someone has said, on the other hand, if I am in the profitable part, then I have intrinsic value. If I am the loss part, I will say intrinsic value is zero. Okay. Second, time value. If we will say, okay, we'll put in the formula side, it is spot minus K. Okay, which means intrinsic value of call is greater of zero, or it is spot minus future. On the other hand, the intrinsic value of put will be A minus S or future minus spot. Okay, which will again greater of zero. Now the another part is time value. Time value premium minus intrinsic value. Now, if we are closer to the expiry, we are closer to the expiry date, then time value will be zero. On the expiry day, time value will be on the expiry day, time value will be zero. If we are closer to the expiry day, then time value will come down. If we are far from expiry day, then time value will be more. Yes or no? Will be more. If we are on the expiry date, time value is zero. Far from expiry date, time value will be more. Near about expiry date, time value will be less. Okay. Clear up to this? Up to this, all of you are clear?
Yes, sir.
Okay. Now we'll do the payoff. Okay. So if you are bullish, now we have two options. One is call, another is put. I can buy call option. I can sell call option. I can buy put option. I can sell put option. Okay. When I will buy call option, whenever I am bullish or bearish.
So bullish.
Whenever I am bullish, I will be buying call option. Whenever I am bullish, I can also sell the put option or buy the put option. Whenever I am bullish, I can sell the put because the sell is right to sell. I am selling the right to sell. I am buying the right to buy. Okay. Second, if I am bearish, I am bearish, then I can sell the call. Yes or no? I can sell the call. Are you getting? If I am bearish, market will fall. Then I can sell the call and again I can buy it over here. Okay?
Sir, I had a small doubt. I missed
Yes.
it. Sir, while calculating in the money, out of the money, and at the money, do we ignore premium or do we include them, sir?
Come again while considering in the money,
Sir,
at the money, out of the money.
we consider the premium, like we add the premium, or do we ignore it, sir?
No, we have to consider. We can't ignore premium. We are paying that, na. We'll come
Yes,
to
sir.
that payoff. We have to consider. So
Okay, sir. Thank you.
that is either coming to our pocket if we are selling, or it is going from our pocket if we are buying. Yeah. So that we have to consider. That was not there in case of say future. Okay. So what I said, if I am bearish, I can sell the call. If I am bearish, I can buy the put. Okay. Okay. I can buy the put. Okay. So let us see how we can identify the premium option, say payoffs of different situations. Have I sent this PPT to all of you in the last class? Have I sent you the derivative PPT? Introduction to derivative PPT, not the derivative pricing models. Have I sent to you, Rahul, Neil?
Yes, sir.
I have sent to you.
Yes, sir.
So
So with the
yeah,
risk
you
PPT,
can open
yes,
that. Sorry.
yes, sir. You sent two PPTs, one other measures of risk, and I think derivatives like introduction to that.
Yes.
Those were
So
the
in
two
that,
yes we received.
yes, in that there are four examples. One is call uh, call option, payoff for call option, call buy. Okay, we consider that premium here. Please go through. Just take 15 minutes. From this side, some noise is also coming. Take 10-15 minutes and understand. Go through all these four. Then we'll discuss. Okay. Those who have not received that, you have already received. Just search your inbox. You will get it. So the task is you need to create also four pairs by considering uh, the price and premium. But first you understand those four that are there in the then create the pair. So 15 minutes spent to understand and 15 minutes to create your own. Okay. So once you are done with 15 minutes, just tell me. I'll explain if any doubt is there. So all of you are getting the concept?
Could you repeat?
So all of you are getting the concept on the
Yeah.
each of the payoffs. Now can you take one either out of the money or in the money? You can take suppose 10,000, right? Then you see you can pay off. Are you able to now? Rahul?
Sir, glitches hai, not audible properly. Your voice is breaking a lot.
Okay. Okay, then you do one thing out of these four payoffs, build up your own payoff and assignment. So in the next class, if any doubt is there on this payoff, I will explain to all of you. Okay. So we can call for the day. Rahul.
Yes, sir.
Yeah. So who are present? Can you just tell? One, tell me who are present. After October 30, we have not done any classes. Rahul.
Sir, me.
No. Our class, I'm asking. Overall, we have not done any October 3rd. What?
The voice break हो रहा है, बहुत break हो रहा है, sir. नहीं समझ आ रहा.
Now I am audible.
Yes, sir.
So I'm saying, what was our last class? It was October 30 or so, or after that we have done some classes.
Yes, sir. It happened on 30th October last.
30th October. Oh, there is a long gap. Okay. Okay. Okay, Akash,
Yes, sir.
Anchal, Ayush, Ayush, Adyansa, Adyasa, Tejas, Ali, Ali Sagar, Anjali, Amul, Arismita, Avani, Avani, Ayushi,
Yes, sir.
Sarvesh,
Present, sir.
Bhavya, Cherry, Diksha, Dipans.
Present, sir.
Who is this?
Dipansha.
Okay, Dipans. Gaurav,
Present, sir.
Gaurav Santosh,
Present, sir.
Himanshi,
Present, sir.
Jaideep, Jaideep, Ayushi, K. Ayushi, Krishnakant, Kriti,
Present, sir.
Mansi, Mansi, Mansimran,
Present, sir.
Manvi, Mihir, Muskan,
Yes, sir. Muskan was present.
Namrata, Neil, Neil is absent.
Sunil was
Nikhil,
also here.
yes, I have given. Nikhil, Prasun,
Present, sir.
Pratik, Rachit, Rahul,
Yes, sir.
Rahul Giri,
Present, sir.
Rahul Goswami, Ra- Rajyaditya, Rashi,
Present, sir.
Rishabh, Ruma,
Yes, sir. Present.
Sahaj, Samiksha, Saranya,
Present, sir.
Shubham, Shubham Kumar, Someshwar, Stuti, Sanika,
Present, sir.
Vinay, Srivardhini is there. Okay. Thank you all. So we'll meet on Saturday. Then rest of the thing we'll do.
Thank you, sir.
Okay.
Thank you, sir.
Welcome.